All right, what happened with Silicon Valley Bank? I'm gonna break it down for you. Silicon Valley Bank tripled its depositories from 2019 through 2021. When depositories come into a bank, it's considered a liability. What do I mean by that? They've got to pay interest on said depository. They've got overhead costs, operational costs, employee costs, compliance costs, etc. So the depository all of a sudden turns into a liability. Now, how do banks make money? Banks make money in multiple ways, but at the simplest level, fees and also loans on said depository. But what happens when there is not enough loans to support the depositories coming in? When you think loans, think mortgages and car loans, credit cards, student loans, commercial loans, industrial loans, etc. That's how banks make money. So when there's not enough loans to support the depositories, then the banking institutions turn to the secondary market, stock market and bond market. And banks love the bond market. Why do they love the bond market? They love the bond market because in 2008, the federal government created the Dodd-Frank Act. And what the Dodd-Frank Act did is it allowed banks to go into the bond market and invest in bonds, which are loans, at what we call federally insured. And what that means, we call this mark to market, meaning that if the bank buys bonds for the full maturity, they're not hit with the market fluctuation. So let's talk about bonds and let's talk about loans. So you've got treasuries. For example, you've got the 10-year treasury and the 2-year treasury, okay? So a longer term investment would give you a bigger return on the money that you put into said investment, 10-year. You got the 2-year treasury over here, and the 2-year treasury actually happens to be less of a return, right? So you put your money in long term, you get a bigger investment. But what happens when rates go up? When rates go up, the inverse happens to the bond market. It goes down. Rates go up, bond market goes down. And all of a sudden, you've got this very volatile bond market. And the short-term loans or treasuries are a lower volatile risk than the long term. So what happens then is that the bond market, when you're investing in bonds, right, and there's volatility, rates go up, bonds are dropping, you're gonna feel that. Now, because of mark to market, you don't have to report this on your balance sheets, meaning the balance sheets aren't real time. It's not really giving you what's really happening behind the scenes on the bank's investment. So the bond market is falling, rates are going up, and what happens to Silicon Valley Bank? So what? It all sounds great, right? As long as the money stays in the bank. Now, if the money is pulled out of the bank, that becomes a problem in a market like we're in today. And that's exactly what happened. Jim Cramer, he showed a big bright light on Silicon Valley Bank and said, Silicon Valley Bank in February is a buy, it's a buy, it's a buy, a lot of room for the upside, we shall be buying Silicon Valley Bank stock. And what money managers and smart investors started to do is they started to peel back the onion. They started to peel back the layers, and what they saw is reality. And what reality showed is the mark to market, meaning that really Silicon Valley Bank was really operating, had a $14 billion loss. And if that were real time on their balance sheet, that would be a $3 billion loss on their balance sheets. Yikes. And so smart money started getting smarter and said, pull your depositories out. And so we started to experience a run on the bank. Silicon Valley Bank, depositories were going out faster than Silicon Valley Bank could do anything, right? So more depositories were being withdrawn, monies were being requested to be withdrawn. Silicon Valley Bank goes to try to get a loan to cover said depository retractions, were denied for the loan, could not sell their stock price because the stock price is in a free fall. Then what happens? Run on the bank. The bank completely crumbles. They start completely selling off their assets. Remember, these are our long-term bonds. They're selling their bonds at a loss, and not a little loss, a 10x loss, to try to get enough money to meet the demands of the depository retractions. And that's what happened to Silicon Valley Bank, and that's what it means to run the bank. Thankfully, the Fed stepped in. They said they weren't going to bail out. They did. They had to. Here's what it means, is the Feds are going to have to stop getting so bullish with raising the federal rate. They've raised the federal rate 450 basis points since last March. Now, there's a lot more layers within this onion. We could talk about leadership at Silicon Valley Bank. I encourage you to go research those leaders. I encourage you to research what some of those people, who those people are, what they did with their stock price over the year, and how they sell their assets. And what's really interesting is the new person coming in as the president of the new Silicon Valley Bank happens to be an ex-president of Fannie Mae, which is the largest mortgage-backed security in the United States. think the feds are gonna have to start raising the federal rate. They're gonna have to stop being so bullish. Remember, mortgage rates follow inflation. Inflation. As inflation rises, mortgage rates rise, and we are going to start to see inflation come back down. On May 10th, we're gonna start to see some great core consumer price index numbers where inflation is going to come down, which means mortgage rates are going to come down. All in all, don't freak out. If you have questions on this stuff, direct message me. All you have to do is hit DM SVB, Silicon Valley Bank, and I'm happy to chat with you about any questions. DM SVB.